Crypto enthusiasts and Web3 professionals, are you looking to learn more about the tax implications of starting or participating in a DAO? Then look no further. In this video, we're going to go over the tax implications associated with DAOs and what steps you need to take as a taxpayer. A DAO is a decentralized autonomous organization where its members come together to work towards a shared goal. This could be an environmental goal. This could be to pool funds together to purchase a specific type of asset, such as an NFT, or for a specific business purpose, or for any other type of related reason. The big difference between DAOs and traditional enterprises is that DAOs are decentralized and the governance structure is on the blockchain, and members are usually rewarded via tokens on the blockchain for their contributions to the DAO. Voting for the DAO is also usually done on chain, and the voting mechanisms are associated with tokens that are associated with the DAO. So what are the tax implications to a decentralized autonomous organization, also referred to as a DAO? The biggest hurdle to overcome when I'm trying to work with a DAO is understanding their tax structure. And it is crucial for DAOs to set up a legal entity structure that's associated with their DAO, so they can be recognized by tax authorities for tax purposes, and they have control over what type of tax entity they're going to be operating on. So most commonly we see DAOs formed as LLCs, but there are other entity structures that DAOs can take depending on the type of DAO and the type of tax jurisdiction that they're operating in. So they could operate as LLCs. They also could operate as unincorporated nonprofit associations, and they also could operate as foreign foundations or limited cooperative associations. So really, when you're sitting down and designing a DAO, you want to have a legal team and a CPA, and you want to sit down with your legal team and determine the best type of legal entity structure from a legal standpoint for your DAO. And then you want to understand how that structure is going to be taxed and how to optimize that structure for taxes. So when you take a DAO and you wrap this in a legal structure, it helps to both protect you and the DAO members in terms of their personal legal liabilities, and it also helps you in terms of delineating and protecting you in terms of your tax obligations and liabilities. During the initial stages of a DAO, there's usually a governance token that's going to be issued or minted by their members. In most cases, this transaction is not going to have a taxable event because these members are simply receiving a token for their participation in the DAO. So usually at the inception of a DAO, the DAO is going to issue governance tokens to the members of the DAO. For the DAO itself, when it's issuing these tokens to its members, there usually isn't going to be a taxable event on the initial issuance of these tokens. The reason why this usually doesn't constitute a taxable event is because there's no sale or exchange taking place, so there's no capital gains event. These are just tokens that are getting issued to the DAO users. Now, after the issuance of the governance tokens to the DAO's members, at later dates, this DAO may choose to sell some of its governance tokens to actually fund the DAO. These transactions are likely going to be taxable as capital gains because you're exchanging the governance tokens for another token, and as a result, this is creating a capital gains event. So you're going to want to track this and report this appropriately via your DAO and your DAO's entity structure on their tax return as a capital gains event. So if you're a member of a DAO and you're receiving these governance tokens, are those going to be taxable? Or overall, it's going to depend on your specific facts and circumstances, but it's highly likely that if you're receiving governance tokens, that in many cases that these can be taxable to the DAO members, and this should be tracked appropriately in their personal accounting and claimed appropriately on their personal tax returns. Similarly, if an individual member is completing services for a DAO or providing goods to a DAO and they're receiving payments for them, these payments are also going to be treated as taxable events and should be reported by that specific DAO member appropriately by doing their personal crypto accounting and then filing this on their personal tax returns. So what other tax implications can be associated with the DAO? Many DAOs are formed in order to pool assets together and purchase various types of crypto assets and NFTs and other digital assets. To the degree that these are being purchased and exchanged, there's likely going to be capital gains events, potentially income events for any airdrops or earning that's done by the DAO. And this will all have to get claimed appropriately at the entity level for the DAO, where they report any allocable income as well as any capital gains related to buying and selling of various digital assets on behalf of the DAO. Lastly, if a DAO is formed in order to sell NFTs, another consideration is sales tax and VAT tax compliance. If you're selling NFTs, there are many states and many countries in which there will be a consumption tax that has to be paid by the taxpayer at the point of sale and collected by the seller at the point of sale based off of the sale price of the NFT. So if you're selling an NFT in a state where state sales taxes apply, such as Washington, you'll want to make sure that you're in compliance with these state taxing agencies and collecting and remitting sales taxes appropriately for the sale of any NFTs on behalf of the DAO. So the DAO itself is going to look at any taxes that take place for operations within the entity that is set up for the DAO, and that will get claimed at that company level. Any transactions that are taking place for members within the DAO that are getting paid from the DAO, getting token distributions from the DAO, these are going to be reported by those individual members. So the DAO itself is going to have tax reporting and accounting requirements, and then the members of the DAO itself are going to have their own separate tax and accounting requirements as well. So the DAO will also have to keep very good documentation and accounting records, and this is going to vary by its legal jurisdiction and its legal entity structure, but usually it's going to have to keep records and information on all of the DAO members, all of the income earned, all of the expenses and associated deductions, as well as any capital gains. The way to do this is by getting your DAO and your company set up on a robust accounting system with a strong digital asset subledger that's integrated with the general ledger, so you can have one true set of financial statements that has a full audit trail for all of your digital asset activity. While maintaining this accounting system, you also want to be careful to contemporaneously document every tax position that's taken throughout the year for any transactions where there may be unclear tax guidance. As you can see, it is key when operating a DAO or when being a member of a DAO to sit down with a CPA and make sure that your accounting and taxes are in order. And the best way to do this is to plan in advance. So if you're a member of a DAO, or if you are starting a DAO and you need tax or accounting assistance, you want to get an accounting system set up, you want to do tax planning around your legal entity structure and make sure that your tax filings are compliant with the IRS, contact me and my team at Camuso CPA today, and I will be able to sit down with you one-on-one to discuss your business, your tax, your accounting needs, and see exactly what steps need to be taken from a tax planning, tax filing, and digital asset accounting perspective to protect your bottom line and make sure that you're in compliance with the IRS.